So um, imagine buying a standard, totally boring hardware stock just a year ago.
Right, like a mature company.
Yeah, exactly. A mature company with, single-digit growth. You buy it at around $28, you stick it in your portfolio, and you just completely forget about it.
Which is usually the goal with those kinds of plays.
Right. But then today, April 16, 2026, you open your brokerage account, and that exact same stock is sitting at $919.47.
It literally looks like a typo.
It really does. But it is not a glitch at all. I mean, it is the reality of what happens when a legacy hardware company accidentally becomes the critical bottleneck for the entire global artificial intelligence revolution.
Yeah, and we are, of course, talking about SanDisk Corporation, ticker symbol SNDK.
Exactly. And before we jump into this deep dive, just a quick reminder to please like the video, subscribe to our YouTube channel, and it's compulsory that you leave a comment with your feedback below. We really want to hear what you think about this one.
Because it is, frankly, one of the most polarizing equities in the S&P 500 right now.
Oh, absolutely.
I mean, the underlying debate that's just splitting analysts down the middle right now is whether this massive ascent is a genuine undervalued entry point into an AI data center supercycle.
Or, and this is the scary part, if we are watching retail traders casually stroll into a massive, historically predictable cyclical trap.
Exactly. The value trap risk is huge here.
So we are going to tear apart both sides of that argument today. We're looking at the latest earnings data, technical analysis, and Wall Street valuation models from our sources. And just as a quick reminder up front for you listening, we are analyzing the research provided to us. We are not giving financial advice.
Right. Always run these numbers against your own personal risk tolerance.
Always. So to figure out if a stock priced at over $900 is built on air or if it's, built on concrete, we really have to look at the financials, the actual cash engine powering it.
Yeah. And if you look at the income statement, SanDisk's recent fiscal Q2 results for 2026 are, well, they're practically unheard of in physical manufacturing.
They really are.
I mean, their quarterly revenue just crossed $3.03 billion.
Which is what, a 31% jump quarter over quarter?
Exactly. But honestly, the revenue itself isn't even the shocker here. The real shocker is the margin expansion.
Oh man, the margins are insane. Their gross margin expanded by over 21 percentage points.
Yeah, it's wild.
They are operating at a 50.9% gross margin on physical hardware. I mean, normally building physical chips is this brutal, capital-intensive business where you fight over pennies.
Right. It's usually a race to the bottom on price.
Exactly. So this isn't just a company selling a popular product. This is, well, it's like owning a hardware store and realizing you're the only one selling shovels during the biggest gold rush in history.
That is the perfect analogy because Google and Meta, they have to cross that bridge to build their AI models, and SanDisk basically gets to set the toll.
Yeah. And just looking at the bottom line on the income statement, their net income multiplied by over 6 times in a single quarter.
Over 600% growth.
Yeah, up 617% to $803 million in pure profit. The EPS earnings per share hit $5.15.
Which is just a staggering annual trajectory if they keep it up.
But, okay, let me play devil's advocate here for a second. When I see that kind of explosive scale, I immediately worry about leverage.
Sure, the debt.
Right. Rapid growth can completely bankrupt a company if they borrow too much cash to build new factories, and then suddenly the demand dries up. So looking at the balance sheet, is this growth actually structurally sound?
Well, this is the craziest part. If you look at their balance sheet, it is practically a fortress.
Really? No massive loans?
Nope. Often when a stock rockets from a 52-week low of $28 all the way up to a 52-week high near 900, it is fueled by debt and speculative frenzy.
Right.
But SanDisk is sitting on a cash flow generating machine. They have over $1.4 billion in pure cash right now.
Wow. So they aren't taking out massive loans at these crazy current interest rates to fund their expansion.
Not at all. Their debt to equity ratio is practically zero. It's 0.08 to be precise.
This is absurd.
Right. In an environment where the cost of capital is incredibly high, they are funding their own hyper-growth entirely internally. The fundamentals today are unequivocally robust.
Okay, so they have $1.5 billion in cash, practically zero debt, insane margins. In a rational world, the stock goes up steadily based on that.
Keyword being steadily.
Exactly.
Right.
But $900 isn't steady. That tells us we aren't just looking at good fundamentals anymore, right? We are looking at a market that has mechanically forced itself into a buying frenzy. Let's talk about the technical analysis.
Yeah, the technical indicators on this chart are absolutely screaming right now.
The momentum is off the charts.
It is. I mean, the volatility is incredibly high for a company of this size, running at over 15.28%, but the trend direction is heavily, heavily bullish.
And we just saw a massive positive signal on the charts.
And we did. We recently saw the definitive confirmation of a golden cross.
Okay, for those of you listening who don't spend all day staring at candlestick charts, a golden cross happens when a stock's short-term average price breaks above its long-term average price.
Exactly.
And specifically here, SanDisk's 50-day moving average, which is at $663.75, blasted right past its 200-day moving average of $291.
And the gap between those two lines is just absolutely massive right now.
So what does that actually mean for the stock price today?
Well, when that gap widens so aggressively, it triggers automated trading systems. Algorithms read that crossover as a definitive mathematical signal that short-term momentum has completely hijacked the historical trend.
So the computers just start buying.
Exactly. They begin executing buy orders automatically based purely on momentum.
But, algorithms chasing momentum isn't even the biggest catalyst hitting the stock right now. There is a massive structural news event happening on Monday, April 20th.
Oh, the index inclusion, yes.
Yeah. SanDisk is officially being added to the Nasdaq-100 index. And, that fundamentally changes the gravity around this stock.
It alters the entire liquidity profile overnight because the Nasdaq-100 is tracked by hundreds of billions of dollars in passive index funds and ETFs.
Right.
The moment SanDisk is officially added, every single one of those funds is legally obligated to adjust their portfolios.
So who is buying? Literally everyone with a Nasdaq index fund.
Exactly. They have to include SanDisk shares to ensure their fund perfectly mirrors the index.
And because it's forced buying, price sensitivity goes completely out the window, right? It creates this guaranteed blind tidal wave of liquidity.
Yeah, a Vanguard or BlackRock portfolio manager isn't sitting around debating if $919 is a fair entry price.
Right. The mandate just says buy the weight of the index, so the computers execute the buy. But, and this is a big but, if you're looking at this chart at home, you have to be asking yourself, if Wall Street already knows this index inclusion is happening on Monday, hasn't the smart money already priced this in?
That's the logical question.
Are retail investors just bidding up the price right now on pure FOMO fear of missing out, expecting a spike that institutions have already front-run?
Well, generally, a massive noon event is largely priced in by sophisticated players. However, the technical indicator suggests the momentum hasn't entirely exhausted itself just yet.
Okay, how so?
If we look at the Relative Strength Index, or the RSI, we can measure the velocity of the price changes.
Think of the RSI like a car's RPM gauge. If it hits 70 or 80, the engine is redlining. It's overbought and due for a pullback.
So where is SanDisk sitting right now?
It is currently hovering around 61.64.
Okay, so the engine is revving hard, but it hasn't quite hit that dangerous red line.
Exactly. It remains technically neutral, but definitely leans bullish. Furthermore, the MACD, which measures the relationship between those moving averages we discussed earlier, is still showing a positive trend, even if the histogram has slowed slightly.
So the momentum is still there. It is. The core difference here is the nature of the buyer. Retail buys the anticipation. Institutions execute blind, mandated orders. That structural buying creates a very rigid floor under the current price in the immediate term.
Right. But if these institutional funds are forced to buy at $900, the logical question is whether they are getting a steal or acquiring a drastically overpriced asset.
And that brings us to the great valuation debate.
Yeah, the analyst models in our sources are completely fractured on this. There is a staggering divide in how Wall Street is valuing this company. Are they undervalued, or is this a trap?
You basically have two entirely incompatible views of reality right now. One prominent group of analysts argues that SanDisk is actually undervalued by almost 67%.
Wow.
Yeah. They are using 10-year discounted cash flow models to arrive at a target price north of $2,800 a share. $2,879 specifically.
Which sounds insane. But the reason the discounted cash flow model is spitting out a $2,800 price tag isn't just because of today's sales. Right. It's because the model assumes AI scaling is exponential. It assumes that global data centers will need to continuously multiply their high-grade memory capacity year over year for an entire decade.
And that SanDisk will somehow maintain that 50% profit margin the entire time without competition undercutting them.
Which, I mean, the math works perfectly on paper, but it requires a perfectly flawless future.
Exactly. Conversely, the opposing camp looks at the exact same financial data and concludes the stock is overvalued by 221%.
221% overvalued. That's a massive difference.
It is, and their argument is rooted in the historical reality of the semiconductor industry, which is famously brutally cyclical.
Right. It has always been a boom and bust cycle. A new tech drives demand. Chip makers build massive billion-dollar fabrication plants to meet it. They accidentally overproduce. The market gets flooded and the prices crash.
So the bears argue that assuming SanDisk can avoid a cyclical bust is historical arrogance. They view the current $900 price point as a temporary anomaly that will violently revert to the mean once supply catches up.
It's like appraising a house in a neighborhood where half the experts guarantee it's the epicenter of the next Silicon Valley, and the other half swear it's built on a sinkhole and will be condemned next year.
There really is no middle ground. But despite the argument that it might be heavily overvalued, I should mention the overwhelming consensus rating across major institutions remains a strong buy.
Really?
Yeah.
Yeah.
Average analyst targets are hovering in the $779 to $904 range. And then you have Evercore ISI pushing a massive high-end target projection of $2,600.
Okay, so with institutions slapping $2,600 targets on this, the momentum is aggressively bullish. But if a highly credible model says it's 221% overvalued, we really need to understand the mechanics of how that collapse could actually happen.
We need to outline the worst-case scenario.
Exactly. Let's dig into the bear case and the hidden downside risks. Because retail traders often get trapped at these peaks.
The primary downside vulnerability is a concept called secular perfection. At its current valuation, the market is pricing in zero margin for error.
Literally none.
Right. Every planned hyperscale data center must be completed on schedule. Every major debt client must continue ordering maximum capacity. If SanDisk experiences a single logistical delay or a client dials back their spending by even 5%,
The illusion of infinite growth shatters.
and the premium valuation completely collapses.
And, looking closely at the internal corporate behavior from our sources, the people actually running SanDisk might be perfectly aware of how precarious this tightrope is.
You're talking about who is selling.
Yeah. The sources show that insider power is currently negative, meaning executives and directors are selling off more shares than they are acquiring.
That's a huge red flag for a lot of people.
We have a specific SEC filing from February showing Director Miyuki Suzuki unloading $2.2 million worth of stock. And she sold that at roughly $627 a share.
Now, corporate filings often reflect standard tax selling or scheduled stock plans, but a $2 million exit is a material statement.
Exactly. I mean, if I'm sitting on the board of a company and I genuinely believe Evercore's analysis that our stock is heading to $2,600, I am not cashing out $2 million at $600.
No, you hold.
Right. That insider selling tells me that at least some people inside the building view these current prices as a historic, once-in-a-lifetime exit point.
That's a very fair assessment. And beyond the insider sentiment, the operational risks are severe. SanDisk does not exist in a vacuum.
They have a massive supply chain.
Right. They rely heavily on deeply interconnected Japanese supply chains, specifically their joint ventures with Kioxia. Any geopolitical tension, localized economic shifts, or even natural disasters in that specific region could instantly paralyze their ability to manufacture these high-margin chips.
Supply chain shocks are always dangerous. But there is a technological threat emerging that I think completely changes the calculus here.
The software side.
Yeah. We need to talk about Alphabet's new project, TurboQuant. This is AI-driven memory compression software.
And TurboQuant fundamentally threatens the core thesis of this entire hardware supercycle.
Explain that for us.
Well, up until now, the assumption has been that smarter AI requires exponentially more physical space to store its data parameters.
Right.
More AI means more chips.
Always more hardware.
But TurboQuant uses advanced algorithms to compress the memory footprint required to run these massive models.
So if I'm understanding the mechanics of this correctly right now, if Google wants to make their AI twice as smart, they have to buy twice as many physical SanDisk NAND chips to hold the data.
Okay.
But if this TurboQuant software gets exceptionally good at compressing that data, the AI could theoretically do double the work using the exact same physical chips they already have.
Exactly. The software effectively optimizes the hardware out of existence, or at the very least, it drastically flattens the demand curve.
Wow.
Yeah. If a hyperscaler figures out how to buy one physical memory chip and use software to make it perform the work of three, SanDisk's volume projections over the next decade are entirely mathematically flawed.
That is wild. The very AI revolution that SanDisk is fueling could be creating the exact software required to make their physical hardware obsolete.
It is the ultimate disruptive threat.
It's terrifying if you're long on the stock.
It is. However, the bullish camp does have a very pragmatic defense against the turbo-quant narrative.
Okay, what's the best case recovery scenario for the bulls?
Well, software development might be advancing rapidly, but we still live in a physical world governed by physical constraints. Memory compression is still an emerging technology. It is not flawlessly deployed at scale across every global data center today.
Okay, so if I'm a bull, I'm looking at that turboquant threat and I'm thinking, sure, software might solve this in 5 years, but I need chips today to train my models.
Precisely. That is essentially the bullish defense, that they have a monopoly on the immediate future. The reality on the ground today is a severe structural deficit in high-performance NAND memory.
Right.
You cannot just spontaneously generate a semiconductor fabrication plant. It takes years of planning, billions of dollars in capital, and specialized manufacturing equipment that itself has a multi-year wait list.
You can't just flip a switch and flood the market with chips to lower the price. The physical world moves slow.
Exactly. Analysts project these supply constraints will last until at least 2028. So for the next 2 to 3 years, SanDisk has a completely captive audience.
The big tech companies have no choice.
Right.
Yeah.
Amazon, Microsoft, Google, they are engaged in a foundational arms race. Negligible compared to the existential risk of pausing their AI development and letting a competitor win the market.
That makes sense.
So SanDisk possesses absolute pricing power in the medium term.
It's basically a hostage situation.
Yeah.
The tech giants need the uranium for their reactors, and SanDisk operates the only functioning mine. They're going to pay whatever the toll is.
That's the reality of the market right now.
So let's look at the outlook. How does this translate to actual price action moving forward? What do the analyst timelines look like for the short term versus the long term?
Well, in the very short term, the market is bracing for severe volatility leading into the April 30th earnings report.
That's going to be a huge day.
The entire street is waiting to see if the fiscal Q3 results sustain the explosive growth we saw in Q2. Because if they miss by even a fraction of a percent, that secular perfection bubble pops.
Right. So what are the downside targets if we see short-term weakness?
Some technical models indicate we could see a short-term pullback as traders lock in profits ahead of that earnings uncertainty. We might test support levels around $891.72.
Okay, that's not too far down.
But if the earnings call introduces any negative guidance, we could easily see the price gap down to lower support structures at $633, or even in a worst-case continuation lower, down to $541.
Wow. A massive immediate correction is entirely possible if the reality fails to meet the hype. But what is the long-term perspective if they actually deliver?
If the data center build-out sustains its current velocity and SanDisk maintains those 50% margins, the bullish models see the stock easily breaking through the $1,000 psychological barrier by late 2026.
$1,000.
Yeah. And looking further out, if we assume software like turboquant fails to significantly dent hardware demand, that long-term 2030 target of $4,357 becomes a mathematical possibility.
$4,300 a share. That is just incredible.
Yeah.
You know, we started this deep dive looking at a stock that was sitting quietly at $28 a year ago.
Yeah.
And today, it is trading past $900. It's supported by a mathematically spectacular explosion in pure profit, a debt-free balance sheet, and a looming mandate that will force index funds to blindly pour billions of dollars into it next week.
Yet, as we discussed, it remains deeply shadowed by executives liquidating their own shares, the historic inevitability of semiconductor boom and bust cycles, and the very real possibility that AI will just figure out how to optimize its own memory storage.
It is the ultimate tension. We're either looking at a generational disruptor that is still fundamentally cheap, or the absolute peak of a classic value trap just waiting to snap shut on retail investors.
In markets defined by this level of extreme momentum, the line separating a visionary investment from a catastrophic peak is incredibly thin.
Very true.
The April 30th earnings will be the definitive litmus test to see if the physical cash flow can continue outrunning the astronomical expectations.
It's going to be a fascinating few weeks for anyone watching this ticker. I want to leave you with a final thought to mull over before we go. We are watching this hardware boom push SanDisk to the absolute stratosphere. Because right now, AI requires endless physical space to learn.
Right.
But if the tech giants are actively pouring billions of dollars into software designed specifically to destroy the need for that physical space, are we witnessing the glorious beginning of the AI hardware supercycle? Or, at $900 a share, are we actually looking at its expiration date?
That is the multi-trillion-dollar question.
Thanks for joining us on this deep dive. Make sure to leave your thoughts in the comments, and we'll catch you next time.